Creators living on this channel is for educational purposes only and is not intended as financial advice. It's Macro Monday. I'm going to start with some crypto institutional flows as we usually do. Had a bit of a interesting morning regarding the industry leader in news, obviously sarcasm, Cointelegraph, tweeting out the spot ETF had been approved. That shot prices up on Bitcoin and has since come back down from 30 to 28. So it's certainly been an interesting day. As far as flows are concerned from James here at CoinShares, still no period, barely a sentence. I'm just kidding, James. But as he says, sentiment steadily improving. Another week of inflows. We'll see what flows looks like for this week. You know, it's always the classic, this week is critical or this week is very important. But as we get closer to a potential spot ETF, a real one, we may slowly start to see flows pick up in earnest again. And as far as where those are coming from, looks like a lot of it is coming, inflows coming from CoinShares and the Purpose Bitcoin ETF. Definitely an imbalance here on the ETH versus BTC flows. You're certainly seeing that on the ETH BTC side of things. Solana popping up a little bit, some inflows into short Bitcoin. And then most of it coming in from Germany, out from Sweden. So Germany just can't get enough Bitcoin at the moment. Small inflows from the United States. And again, expect that to just completely get blown out of the water once the BlackRock ETF is approved in a good way. You know, you're going to see dominant flows from the United States pretty consistently, I'm guessing. And the reason why, again, a spot ETF is important, when we have a low cost option for exposure in traditional finance, we can start seriously discussing inclusion into something like a 60-40 portfolio or a 730 or whatever it is. And you can backtest what additions of something like Bitcoin would do to the portfolio. And it historically has been extremely positive on all metrics. This is talking about when to rebalance. That's the next step in this adventure. And it looks like, based on backtesting, a yearly rebalance proved to be the most effective. So if we want flows to come back, that's what we need. A real deal product where people can access it safely. If we look at this week's news and Fed speakers, you know, it's mainly Fed speakers. There's 14 instances of Fed speakers. Some of these are the same speaker, but it is nonstop every day. Powell on Thursday. Just so many people talking. Not a lot of data. I mean, jobless claims, sure, but just something to look forward to for the week. And back to legacy real quick, just to mention GBTC that also popped up pretty significantly. Semi-filled the gap. So it opened at 22, went to like 23.5, has sold off since. This inverted head and shoulders broke out, still within the channel, still above the cloud, discounts closing. So everything makes sense, regardless of whether or not that news was real, which it wasn't. But the market was primed for something anyway, and arguably based on the non-news news Friday, which was the SEC not appealing the GBTC ruling, this was bound to break out anyway. So anyway, as expected, this broke up. Still looks fine. Obviously, the fake news complicates things, but ultimately I like low 30s for GBTC just based on the weekly edge-to-edge move. And before we go any further here on the legacy side, let's take a look at today's video sponsor, Kraken Pro. Kraken Pro is a complete overhaul of the Kraken trading experience with a one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro with the link in the description of this video. And immediately I went to the volume today, and you know, last night it was like a 30 million at a 24-hour clip for volume. That spiked up considerably to 200 million, well above Tether, and certainly well above most alts. You know, there were some responses here on the Solana side, BCH. What else popped up here? Render is the AI token. But as expected, you know, most of the volume and volatility coming on the Bitcoin side of things. And we're going to need to see how the chips play out at the end of the week. A bit surprising we are holding 28. So we'll see what the weekly closes, but so far so good, regardless of the news being real or not. One thing a lot of people are immediately checking is, where did this news come from? Was somebody positioned long into this news effectively, expecting the market to move? Just looking at the Kraken flows, this is the taker imbalance. So, market buys effectively. And most of that was around the news. I didn't really see too much of that prior, the night before, the day before, whatever. You see a little bit of that, but it's hard to know what was exactly moving last night. The market as a whole started to drift upwards. Anyway, there was like 100 million in liquidations. And then lastly on Kraken here, I mentioned the fees yesterday. I didn't actually share this fee schedule, but you can check this for yourself on Kraken relative to any other exchange. And it's one of the reasons I've traded on Kraken for years. The fees are just lower. I mean, it's kind of no contest relative to the other onshore exchanges. Let's shift gears here to inflation and rates. And inflation has ticked down slowly here. This is going to be very noisy on both the Trueflation and CPI side of things. And as much as we want to maybe celebrate this, this does not represent inflation. It represents the rate of change in inflation. If you look at the aggregated rate, as it says here, average American purchasing power has eroded by about 25% since January 2020. And what we're really measuring is the rate of change. If we look at last CPI versus next CPI, we should get a small bump down from 3.7-ish to around 3.42 based on the Fed's own estimate. Still above expectations or target goals, right? 2%, but we're headed in the right direction. Ever so slowly here, we're creeping down. On that last CPI number, core goods down, shelter up slightly, core services at minus shelter also continuing to hold slightly higher. So we're getting there on a rate of change basis where we're flattening out, normalizing. But again, it's that erosion of purchasing power that we're all feeling with prices still higher. You might see some headline that CPI is down significantly, but that's meaningless relative to the amount we're paying more for everything now relative to the past couple of years. And it's even highly variable based on where you are in the United States. We've got the Midwest and the Northeast maybe faring the best relative to west of the Mississippi, west of the Continental Divide, the South, right, Florida, and then Hawaii and Alaska are kind of their own animal completely. So it kind of just shows you and illustrates the regionality with inflation right now and how it's extremely local depending on where you are. If you look at gas prices in California, for example, they're probably at like 6+ or something relative to Texas, closer to the refineries where those prices are probably much lower. There's fewer taxes on gasoline, that sort of thing. But obviously housing a big proponent of that or component of that as well. Looking at the Fed probabilities, this is probably the lowest I've seen it, at less than 10% for a raise in about 15 days. So the Fed doesn't really need to keep raising if the bond market is raising for them. If inflation is continuing to slowly decline, talking about the long and variable lag of monetary policy, that is certainly taking into effect here. So I don't think there's a big rush for the Fed to do anything in the moment, but this is again month by month, right? We're going to see. And that's what Powell's likely to say in November. We're going to take this data point by data point and see where we need to go. Until something breaks, they certainly aren't going to be jonesing to decrease rates anytime soon. Looking at the dollar and dollar strength and rates, all this is again kind of related. If we have a strong dollar, we probably have rising rates. If we have rising rates, the long bond is suffering, banks are in trouble, Main Street is in trouble, mortgages are more expensive, car loans are more expensive. All this stuff is intertwined and interrelated, which is one of the reasons why they say don't fight the Fed. But just looking at the technicals of the dollar, I'm still expecting, based on technicals, a bit of a retracement here from the dollar. This could go to 104 and then go to 111 easily. That's not off the table at all here. But in the moment, this does look weak to me. And there's even further evidence of a head and shoulders fractal on the dollar. So seeing some Q4 weakness and then, Q1, Q2 strength or whatever picking up again, I don't think is completely out of the question. Before I talk about treasuries at all or bonds, definitely I'm going to link this in the video description. Read through this thread, answers a lot of questions about how we issue debt, what, bills, notes, bonds, etc., what those are, the whole mechanics and the pipeline, how this all works. There was also really good what Bitcoin did with Joseph Wang, who's a previous Fed employee talking about how all this works. So I would definitely give that a listen as well, just to help understand what's going on. It certainly was really good from my perspective. As far as the 10-year yield is concerned, we still have people just absolutely throwing money into TLT, and that makes complete sense based on the previous 35 years. Bond market prices were bullish, rates were going down. Now we have rates going up, prices going down. And there's this assumption that we're going to, I guess, snap back to sub 3% or something. But just based on technicals, again, this is people saying, I'm shorting the top, right? This is exactly how you get, from a pure price perspective, short liquidations or just slingshots continuously higher. Until people actually capitulate and say, you know what, you're right. This is the price now. Instead, they're saying, no, we're going to keep shorting this effectively, and we're going to keep longing TLT. So I think there's still a bunch more tiers left for these people. Now, they may not care, right? If you're holding long term, what do you care? You're still getting that 4.5 to 5.25 rate, whatever it is. You'll do okay. But again, this is another reason why the Fed doesn't need to keep raising. The bond market is doing it for them, And if we look at how this creates changes in flows and changes the dynamic in the conversation, this is exactly it right here. The 6-month T-bill yield currently much higher than the S&P 500 earnings yield, higher than it's been since pre-2008. So it is much easier. The friction between risk and risk off is completely gone effectively if you can get the same yield, risk-free, a low duration and high duration, treasuries and bonds. And again, as Joseph Wang says, the 30-year bond is now 10% in 2 months. This is the bedrock of the entire global financial system. So this is a problem. And we're seeing that on the BTFP side of things. We've yet to see it on a lot of the commercial real estate side of things. Probably more to come on the regional banking side of things. Housing obviously coming to a screeching halt. Car loans soon to come to a screeching halt. Credit cards soon to come to a screeching halt. This is not a surprise. It is not shocking. Like, this is what happens when rates go up at the speed they've gone up. So I don't think it's fair to be surprised at any of the data we're seeing. This is just cause and effect, right? At least to me, that makes sense. So to see TLT continuing to decline, again, this is the opposite of the yield. So people buying down here are saying, look, I'm confident that this is either a bottom in TLT, or I'm confident that longer term, I don't need to bottom tick the bottom, but it's good enough. This is down 62% or whatever it is from the highs, and it's good enough for me for a long-term bet. And that's fair. But bond volatility is also extremely high right now, and that's pulling people out of risk markets even further because they're like, you know what, I'll just play TLT rather than playing risk markets. So we're just not in an environment until all this settles down, rates and TLT, long bond, whatever, yield curve uninverting, let the recession happen, get it over with. Okay. Then we can talk about risk markets in an earnest way, because right now it just makes more sense to me to go into short-term treasuries or to play the bond volatility. And just to show you how ridiculous this is ARK versus TLT since what was probably ARK's inception, I'm guessing, or some long date back, right? 2018. And the P&L for TLT, it's down more than ARK. I don't think this includes, reinvesting yield, but it might include that. Anyway, it just goes to show you how crazy, if you look at ARK, which is the embodiment of crazy stimmies mania type stuff, and it's actually stabilized relative to ARK, which is continuing to decline. And we have a lot of this short treasury positioning, which is, again, some sort of cash and carry trade on the hedge fund side that's super, super levered beyond 100 to 1. But this certainly still needs to stabilize before we have a positive risk conversation. And here is another new high in the usage of BTFP. As they say, there's nothing more permanent than a temporary government program. And this is, to me, expected, right? If long bonds, if TLT goes lower, if rates go higher, banks are in more distress. They need to reach out to BTFP even more to get those long bonds at par. So until rates come down on the long end, you're probably going to see BTFP continue to grow. And this is a great metric for banking stress just generally. And then looking at flows, again, it's no surprise if rates are the highest they've been in decades effectively. You're going to see outflows in equities and into safe, risk-free yielding products. This is just what happens. So it's good to see data for that. But again, don't be surprised if risk markets don't have flows right now. One thing we really need to pay attention to is the reverse repo market, which is, to me, representative of money that was in short-term treasuries that's investing now effectively into longer-term treasuries. And once this runs out, then we'll really see what the market's made of, because there continues to be this question, who's going to buy the government debt? They keep issuing it. Foreign governments aren't buying it. Banks aren't buying it. It's Main Street. It's Tether. And that's about it. And if we look at the auctions coming up for 2024 on all of the durations, tenors, as they say, they're increasing. So we're going to continue to issue more and more across the yield curve. Who's going to buy this? If nobody's buying this, yields go higher. And if you have no idea what I'm talking about, read that thread from James Lavish about the treasury auctions. And you're going to continue to see more data points like this, where we've had historically passive funds, mutual funds, pensions, foreign investors, which a majority of it, other investors buying, the U.S. Treasury market. Now it's Main Street. The Main Street is picking up the bag, and Main Street is going to be in trouble if rates keep going higher and prices keep going lower. If they sell, right? If you're locked in, you don't care. What does it matter? But if Main Street gets nervous and decides to sell the bottom effectively on TLT as it potentially goes lower, then households are just in more for a world of pain than they otherwise would be. Looking at some charts from Bianco, just again to hit this point home, a 3-month bill relative to the S&P from June 2021 has outperformed the S&P. So it's getting harder and harder against the Russell IWM. It's outperformed. It's getting harder and harder for risk to catch a bid if people are throwing money into money market funds where it just makes more sense in the moment to put that money. Now, to me, this does represent dry powder. This does represent money on the sidelines, but it's going to be harder for risk markets to go up if you've got equity outflows continuously, if it's just a safer place to go. Now, unfortunately, despite the inflows into treasuries or bonds, the government is still issuing more than can be absorbed, right? You need foreign governments. You need some outside exogenous entity buying the debt, and we're just not seeing that. And that's how rates on the supply side just go higher anyway, right? So a lot of interesting stuff coming up next year, whether or not that'll lead to yield curve control, which is where the Fed has to step in and buy the debt and basically puts a ceiling on rates. And that's how hard assets win, because we're effectively just printing money at that point with no consequences. Looking at oil, it had a bit of a volatile week following the production numbers that came in on the US, the demand numbers that came in on the consumer spending side, and then the breakout of war in the Middle East. From a technical perspective, this to me is still a leave alone. I'm not a trader of events anyway. So I know there's people that are trading on news 24/7. That's not me personally, but I can see an argument for that. Maybe you're hoping for some sort of double bottom here. I just think at this point, this is a massive mega chop. Even though it does lean on the bullish side of things, I'd want to see this reconsolidate probably for the rest of the quarter, just based on the cloud. And from an energy inflation picture, we don't want oil to 100. Certainly, it's much better for inflation if oil continues its decline to sub 80, although admittedly that's going to be tough with a war in the Middle East. These are the total crude oil production numbers. And as Mike is saying here, look, we don't need an SPR if we can just make these barrels ourselves. There's some argument to be made there where the SPR is needed if we don't have production. But if we have production, SPR is arguably less necessary. And here's another interesting graph discussing, regardless of rigs going down, productivity is back to all-time highs. This isn't a comment on the political impacts of regulations, but it's just saying, look, we're doing okay. It could be much worse on our side of the pond here for oil production. And let's change gears back to the consumer. Magically, this chart, you're going to see one of these from me every week, because I see about 5 a week, and I pick the best one to share with everybody. This is excess household savings, and we magically found, what is this, $1 trillion more in savings. I don't know what to believe. These are all estimates anyway, but it doesn't help that most of that is coming from extremely older age group, and they walked up the ladder and then kicked the ladder down as far as letting the next generation thrive. The 65 and older crowd is where all the spending is coming from, and they have most of the money right now. Boomer wealth is significant. We still have strikes going on. UAW, Kaiser Permanente, the SAG, AFTRA, actors strike, as BOA says here, the most striking workers since 1983. So if those demands are met, obviously prices are going to go higher across the board. You're going to see higher car prices. You're going to see higher healthcare costs. You're going to see higher everything. People are striking because they've lost a quarter of their purchasing power. It only makes sense. If you didn't get a raise equivalent, you're losing money. So I certainly am on the side of the worker here. If you can't afford to live, what are you going to do? You either give up entirely or you ask for more money, better working conditions. That's what people are doing. And look at the 1980s, the number of strikes relative to the double dip in inflation in the 70s. It makes sense. On the rent side of things, again, hyper regional, right? Wouldn't necessarily expect the Northeast to have the highest rent, but maybe that's people moving out of Boston, out of New York City, out of New Jersey. I'm not quite sure. Midwest on the lower end there, the sunshine flyover states maybe on the lower end there. But it's always interesting to dig into these numbers a little bit regionally to see the variation, the wide variation in rents here. All still rising, by the way. We haven't quite tamped down the rent side of things. And if we look at rent versus buying math, we're still favoring renting. So I'd argue not a great place for society to be as a whole. And then if we look at mortgages relative to costs, again, this is the opposite of TLT. TLT and the 10-year yield, right? Yields go up, prices go down. We've seen mortgage rates go way up for housing, but we have not seen housing prices go down, mainly because we have a supply shortage and the people with a 3% or less mortgage aren't going to move into a 7.5% to 8% mortgage. So it's going to further exacerbate the supply problems. But you can see how much less of a house you can afford if we look at the housing prices on the left y-axis there and mortgage rates on the x-axis. The payments go extremely less far relative to where they went just a couple of years ago, from 3% to 8%. So what we would really need is housing prices to come way down or rates to come down, which probably isn't going to happen anytime super soon. And again, back to this used car or new car conversation, I don't know how people are affording $1,000 a month just in the car payment, right? This isn't including insurance or anything else. And this is 17.5% of new buyers, 17.5%, have a new car payment of more than $1,000 a month. Just astronomical. So I think right now this is acceptable and continues to grow, but eventually this is going to hit a tipping point where people are just saying, look, enough's enough. I can't afford a $1,500 car payment, and just sort of throw up their hands. If we look at the subprime, deep subprime APR for new and used cars, again, at some point this hits a level where it's just unsustainable. And I think we're getting there slowly but surely. And we're getting a grinding halt in the number of boomers who can buy 6 cars, right? Eventually that's going to continue to slow down. The used car index is still quite elevated. You can see the pre-pandemic trend all the way down near 175, not even close. Currently at 214. So we still got some time there. And then on the charge-offs front, which is banks just saying this debt is gone, we're never going to recover this. We're seeing a strong rise in debt that is being charged off. So that's not a good sign either. Collectively, this just says the cost of capital is getting too much to bear across the board, and the beatings will continue until morale improves, which I think is a big reason why people are sort of scratching their head at this S&P move from the beginning of the year up until mid-year, and are more aligned with what's happening and has happened over the past few months. Based on the technical side, to me, this whole thing, anything from 4,200 to 4,500 is chop zone. That is short-term treasury zone. That is get paid to do some yielding. And you know what, if Bitcoin breaks out, even better, because then there's even more of a differential relative to the S&P. Daily cloud flipping bearish here. So still in mega chop territory. And this would be the first Kumo twist since the beginning of the year, which is the cloud just saying, hey, if you weren't sure before with the bearish ticket cross, with the price moving through the cloud, we are leaning bearish. We've no longer holding any bullishness, any neutrality. We are currently in the midst of actively flipping the trend completely. And here's some counter programming for you. The 2021 fractal relative to the current moves. And this is sort of, that cup and handle idea, which I'll believe it when I see it, right? But that goes back to if this, then that. If we're above 4,500, sure. Yeah, I like an all-time high retest. But in the moment, mega chop, risk reward is poor for either trade. And I just think it's time to sit on the sidelines here in the moment. On the Qs, they look certainly better than the S&P from a trend perspective, but the cloud is not screaming to go long here. It's still in the cloud, bearish TK cross, and very much still in the short-term chop zone for me on the Treasury side from 320 to 380. You can probably cheat this a little bit if we start to creep up above this diagonal resistance, bullish TK cross, that sort of thing. But I think it's way too early to think about that. Now, long term, if you're on your vision board, drawing out possibilities here, this is the cup and handle that people are starting to talk about and mention. And man, what a world that would be. Now, we were talking about dollar strength. I think we would have to see a severe decline in the dollar. We would have to see rates somehow come down. We'd have to see yield curve control probably. I don't know, something crazy to get this. But technicals are trying to set up for that. And the ultimate irony here would be if NASDAQ broke out of its cup and handle before gold did. Gold's had a cup and handle for like a decade or more. I'll just mention ARK again because ARK still has this inverted head and shoulders quality to it with a pretty big edge-to-edge setup. This isn't active yet. Ultimately, until this is above the volume area, probably around 45 and in the cloud, then you're probably safer. This is definitely a wait and see. Well, many people lean extremely bearish on this and extremely bullish on TLT. So it'll be interesting to see if for some wild reason, right, we get this cup and handle playing out on the Qs and we get ARK going back to 77. That'll be a wild world, and that'll probably be Bitcoin at 42 plus at that point if ARK is at 77. But in the moment, we chop around, we deal with fake news, and we hold below 30. That's all for this one. Like, dislike, comment, share, subscribe, and happy trading.